This is a beauty, okay? I'm just gonna say, because when you have bullet like titles of some of the data points here is Feliz Navidad. I mean, come on, we're talking. It's beginning to look a lot like contrast. I mean, this is good stuff here, Liz. So talk
I
to
know.
me a little bit, because again, I do think it's fascinating. We threw that Dow chart up there before. It's 20% off the lows. It's down about 5.5% of the year. Again, this is a price weighted index of 30 pretty random stocks, not industrials. So,
Right.
you know, why do we quote it every once in a while? Because a lot of people who don't stare at their FactSet machines all day long, watching every tick of every stock and you know, they quote the Dow and they look at the Dow and they think, oh, we're in a new bull market. Are we in a new bull market?
No.
Okay.
The other reason, I mean, people love drama. So the Dow is the one that moves in the biggest point amounts every
Correct.
day. So people just love that drama. Anyway, lens into Liz personally. I love Christmas. I love Christmas music. I know all the words to every Christmas song. I can do the 12 days of Christmas from memory. Anyway,
well, hold
all
on.
of
And
December.
You're very generous on Christmas. You got me a very nice gift last year, a very nice bottle of scotch.
I did.
I was just saying to my wife last night at dinner, I was like, I got to do something nice for Liz, because that was something nice.
I give gifts. I also expect to receive them.
All right. Well, you got one coming here, and we'll disclose it in a couple of weeks on Market Call. How's that? All right.
Great.
Sorry
Perfect. Okay. But yeah, about the Dow. Look, 30 stocks. Also, guys, the biggest stock in that index is a healthcare name. It's a health insurance company. The top 5 names in the index, nothing in tech. So that's why the Dow has done well. When tech has been under pressure, and you're in a year where technology is the most hated sector on valuations, on growth expectations, everything, as rates are rising, and then you've got an index that is not heavily weighted in tech. I mean, obviously that's why it's done well. Is it indicative of the US economy? Absolutely not. Absolutely not. So the note this week was really, it wasn't just about the Dow, but it was about the idea that there's these huge spreads between a couple different groups in the market. So that can be broad indices, that can be small versus large, that can be high vol versus low vol. So it hasn't really been just this overarching theme of everything fell this year. Yes, everything fell, but some stuff fell much further than others. And I think that that theme is going to persist into 2023. So this is sort of a preview, kind of setting you up for what my 2023 outlook will look like. But these spreads between certain groups are huge. They're historically huge. And that Jack Frost nipping at the lows is about low volatility stocks. That had been, a lot of people piling into low vol, piling into things like consumer staples and utilities. But you know what? Some of that stuff is now really expensive. So be careful to not pile in and be the last one on the pile, right?
Yeah.
And then lastly, small caps. I know I talk about small caps all the time.
But this is really important. And you were just saying this just a couple minutes ago, is like, let's watch different pieces of data. They're going to help inform different sorts of investments, or how you may want to rotate into, other areas of the market. So you're saying that if the June CPI print just above 9%, which was a 40-year high, if that's it, then you want to start looking at small caps. Talk to me about that.
That is absolutely right. So we've talked about a couple different things as times that could be a catalyst for the market to turn a different direction. A peak in CPI is one of them. Another one is a Fed pivot. If you just look at a peak in CPI historically, so if you go back to that late 70s, early 80s period, which is what we're looking at on this chart, the CPI peaked at 14.8% in March of 1980. And then the magenta line is small caps, the blue line is large caps. Small caps outperformed handedly after that. They have actually outperformed since that June print of this year. They've done about 200 basis points better than large caps over that period. So that is important to pay attention to. And I think that could be the beginning of a longer term trend. Now, CPI still has to come down quite a bit, but part of the reason this happens is as the Fed tightens, obviously you've got a huge dependence on large cap growth names in the large cap index. Small cap isn't getting hit the same way by that. And the sector makeup is just different. You've got a lot of financials in there. You've got a lot of healthcare names in small cap. They're just not quite as sensitive to that downside from rates. And then coming out of a recession, if that's something that we go into, small cap value wins almost every single time. So make sure that you do not ignore small caps in this case.